Hey, well, welcome back. It's Mark Filton Pritchard here again, and I have just come back from being at least a week, 2 weeks away doing a whole lot of stuff. So I figured I'd get back to something I really enjoy doing, which is ACCA. What we're going to be looking at today is capital asset pricing model, and this is really aimed at ACCA paper P4, which I used to teach and advise on for many, many years. If you remember back to your syllabus, capital asset pricing model is one of those ideas of a theory. As someone who's only ever really worked in practice and has never ever worked anywhere in anything to do with a university, I have to say that I've never really seen this thing used in practice. We used it once in a country which is Poland. Right, what capital asset pricing model does is it says if you know the risk of a security, then you should know the required rate of return. So we calculate the risk on a security. So security here means a share. So a share in British Telecom, a share in Ford Motor Company. Once we know that risk, then we can calculate what the price is. Okay, let's just recap very quickly. What are we doing? This is ACCA paper P4, so you're nearly there at the end. ACCA paper P4 has some practical elements and has some theoretical elements. Capital asset pricing model is one of the theoretical elements, and it's a theoretical model on how we can value a share based on the risk of that share. Okay? Right, I have to say one thing that's really, really important. It makes a lot of assumptions, and those assumptions are all based on modern portfolio theory. So therefore, if you haven't watched my video on portfolio theory, it's on the website, it's on YouTube, you have to watch that first. Because I'm simply going to go, okay, we know that this happens, and the reason we know it happens is because it comes from portfolio theory. So please, 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 you must watch that first, otherwise you're not going to understand this. Okay, see you in a minute on slide number 1. Okay, and of course when I said see you on slide number 1, I of course meant see you on slide number 2. Always good to start off with something like that. Right. I said already, and I'm just going to keep repeating this, and you're going to get sick to death of hearing this all the way through, but you have to understand portfolio theory. As far as paper P4 comes up, portfolio theory very, very rarely actually comes up in the exam if we're doing this for ACCA. And that's actually a real shame, because you're going to do a whole load of these theories, and of these theories, the one which is the most relevant and the most used in real life is actually portfolio theory. You are going to end up using capital asset pricing model. It's almost certainly going to be in your exam somewhere. And I have to say that people don't really use it that much in real life. Okay, so quick recap, portfolio theory. That's really what this slide is all about. If you remember back to all my graphs and all my pictures and stuff, you will remember that what we're trying to do is we're trying to maximize our return in relation to our risk. Right, that means for a share. So you take a share, British Telecom, you take a share, whatever, any company anywhere in the world, and the object of the exercise is to maximize the return in relation to the risk. Risk may rise from industry to industry, so it's this idea of increasing return in relation to the risk. So when you look on your slide here, slide number 2, the underlying premise is that we want the best return in relation to the risk. That's the first thing. Right, the second thing that that sentence tells you is that the portfolio, so remember we have this idea that when back in portfolio theory we owned one share. The share had a risk and a return. We found that the way to maximize the return in relation to the risk was to diversify. So we diversify. This idea that we sell some of our shares and we buy some shares in a second company. So you go from owning shares in one company to owning shares in 2 companies. That, as long as you buy the right thing, will increase your return in relation to risk. I hope you remember back to portfolio theory that we buy shares whose returns are negatively correlated. So we started with one share, it had a risk and a return. We want to increase the return in relation to the risk, so we sell some shares in the first company, buy some shares in a second company. Which shares do we choose? Shares which are negatively correlated. Negatively correlated means as the return on one share goes up, the return on the other share goes down. Right, the example that you'll see all the way through your notes and in all the textbooks are ice creams and umbrellas. On a nice day, people buy ice cream. If the weather gets worse, then people will not buy as much ice cream, but they will buy umbrellas. So your company will make two products, one is ice cream and one is umbrellas. Do we see this in the real world? Yes, we absolutely do. Those of you who've been in the classroom with me will know I give you the example of British American Tobacco. British American Tobacco, and they don't do this anymore, but they used to have two divisions, many divisions, but two of their main divisions. One was British American Tobacco, they manufacture cigarettes. The second division, life assurance. So life assurance is when you are gambling with them how long you're going to live for. The less you smoke, statistically, the longer you will live. Almost perfect negative correlation. Right. Underlying premise, therefore, best combination of risk and reward is presented by the market portfolio. What does that mean? If we keep extending this premise of selling a few shares and buying a few more, we will find that what gives us the best possible combination of risk and return is the market portfolio. And the market portfolio is a combination of shares which exactly mirror the market. Now you get this in real life by using things called index tracker funds. So therefore in real life you can Google index tracker funds and you will see that this is in fact what people do in real life, and these things really exist. Following on, so these are assumptions. This market portfolio gives us the best combination of risk and reward. Intelligent investors, or hopefully investors who are not that intelligent but listen to their finance teachers, will seek to set up the market portfolio. So investors therefore will buy small blocks of individual shares and they will seek to mirror, seek to copy the market portfolio. There we go. Somebody's just come to our office door. Brilliant. Oh, and he's gone again. Right. Therefore, risk can be expressed in relation to the market portfolio and it can be measured. Right. And this is what capital asset pricing model is going to do. It's going to measure risk. In relation to that risk, it will tell you what the required rate of return is. And the way it does that, you will see in a second. Okay, sorted out our domestic issues. Our office supplies have been delivered. Right, slide number 3, capital asset pricing model. So, as the slide says, the theory runs like this. So remember, this thing is a model. The value of a share in a company has a risk and a reward. I can't really add anything to that. It has a risk and a reward. Anybody purchasing this share will already own a diversified portfolio of shares. Right, now that's important. It's telling you therefore that we are looking at purchasing a block of shares in a company. Call it British Gas, British Telecom, Ford, whatever, Verizon over here in the States. When we're doing that, we already own shares in other companies because we are intelligent investors, or what they call rational investors. Excuse me. And we will seek therefore to construct a market portfolio or something which approximates to it, because the market portfolio gives us the best balance between risk and reward. So that's your background. Now let's just have a little look at what it tells us about the risk of a share. It tells us that the risk of a share can be split into two separate elements. Right, now this is black and white. In real life, this is absolutely not black and white. But as far as capital asset pricing models goes, well, this is way back in the 60s. The guy was called French. When you look at portfolio theory, the guy leading portfolio theory was called Markowitz. His senior guys, who were his assistants, moved on to do this. So we can split this into two different types. Now, when you look in textbooks, you'll hear it called systematic and unsystematic risk. But I like to make it more simple than that. The first thing is what I would call inherent risk. Inherent risk is risk which, now you've got to get this right in your head. This is risk which only affects your company. So we are looking at buying some shares in Ford Motor Company. There are therefore a set of risks which only affect Ford Motor Company. So risks of the specific models that they make, risks of the specific HR policies that they have, risks of the specific way in which they finance their projects. Right, get this straight in your head. And you're not going to be asked to write a list of these or anything. You just have to get the concept. They are risks which only affect Ford Motor Company and no one else. Okay? So they are specific to Ford. They're specific to Ford. Right, the second type of risks are risks which affect everybody, every single company in the market. Because remember, we're talking about the market portfolio. So therefore, these are risks, so inflation, labor risk, tax risks, and so on. So these affect everybody, not just Ford Motor Company, but also General Motors Motor Company, and also companies in other industries. So they'll affect Deloitte, they will affect supermarkets, they will affect toy companies, everybody. So we've got this idea of specific risks that only affect the Ford Motor Company, and then risks which affect every single company, irrespective of their business. We're going to change that when we come to later videos, but for now that's the way you need to look at this. Now let's have a look at the next point. We own a portfolio of shares. That portfolio of shares is spread around many companies. Assuming we're still talking about Ford, we're going to buy some shares in Ford and we're going to add them to that portfolio. In terms of the specific risk of Ford Motor Company, of those shares, therefore, that risk, in terms of the overall portfolio, is what an auditor would call not material. So therefore, we're only looking at the overall portfolio, and the specific risks that belong to the Ford Motor Company, as far as the overall portfolio is concerned, are not material. So they can be ignored. And therefore, when you read textbooks, you'll hear the talk of, we have diversified away these risks, because these risks have gone. Okay? So that's the logic of what we're doing now. We're only interested, therefore, in the effect of market risk on these Ford shares, because the specific risks are irrelevant, are immaterial, in terms of the overall portfolio. Right, can I say that extrapolating that or using that in real life is absolutely not true? There will be some risks that affect the whole of the industry, but don't affect the supermarket industry. So, skilled labour shortages or whatever. And it's a huge assumption that we just cut all of this stuff out. That is part of the thing. It's a model. We'll come back to the weaknesses of the model and why it doesn't work later on, but you need to know this stuff for your exam, and you need to get this logic of what we're doing. Okay? Moving on, therefore, it says, in terms of the overall portfolio, specific risk is immaterial because it is diversified away, and all that is important is market risk. Blah, blah, blah. Right. Risk can therefore be measured as the relationship between the performance of the market portfolio and the individual share. So all we're interested now, therefore, is this market risk, and therefore the mathematical relationship between market risk and the risk of your share will give you a measurable risk for Ford Motor Company. So what is the relationship between market risk and the risk of the share itself? And that's what you're going to calculate, this mathematical link between the risk of the market portfolio and the risk of Ford Motor Company shares. Okay, that's the theory. If you've done portfolio theory in advance, and all it takes is 20 minutes to watch me yak away, so I really strongly suggest that you do that. This stuff will start to make sense, and it becomes clear. It has various fundamental weaknesses as far as real life is concerned. Learn it for the exam, and you'll never need it again. Okay, so nice and short slide here. You remember back from your previous slides, therefore, all that's important is the relationship between the risk of the share and the market risk. Remembering that the share itself has two types of risk: specific risk, which relates to it specifically, and the risks that relate to the market. The specific risks we can ignore because they are not material. So what we're going to do, therefore, is we're going to see what is the relationship between the market portfolio and the share itself. And any differences will be due to the riskiness of the company. Right, that probably is not particularly clear in your mind. So what we're going to do for you now, therefore, is we're going to show you how we do this. And then when we show you how we do it, it should all become much clearer. So we measure, just to recap, we measure the rate of change of the performance of the individual share compared to the market. Let me show you how we do that. Okay, there are slightly different ways of doing this, but the basic technology is the same. When you look into some textbooks, you might see a little bit of changes compared to this. But this is the basic way that this is done. And there are numerous universities, certainly in Britain. I used to teach for the London Business School down in Regent's Park in London, and the guys in my corridor actually used to do this. So let's have a look at what we're going to do. We're trying to find out what is the relationship between the risk of our individual share, which we said was Ford Motor Company, and the market portfolio. So have a look at your graph first of all. On the left, you have a thing which is called RJ. RJ is the return on an individual share. So in our case, Ford Motor Company. On the bottom of the graph, you have RM. RM is the return on the market portfolio. So we've got these two things, and these are our two axes. I get that right? Axes. Yeah. Right. Now have a little look on your graph, and you see on your graph that there are some sort of grey-brown dots, which is as good as PowerPoint Graph Maker does for me. Right, if you count those dots up, you should actually find that there are something like, there should actually be exactly 12 dots. And each dot represents a month. So what we've done for a 12-month period, let's assume it's 2014, is we've plotted for January what is the return on our Ford Motor Company share, and we've plotted that against what is the return on the market portfolio. Now, having watched my rather wonderful portfolio video, you will know that return comes in two forms. One is capital gain and one is dividends. So during January, what was the return on Ford Motor Company, dividends plus capital gains, against what was the return on the market portfolio? Right, what we do, because most companies pay dividends once or twice a year, is we smooth the dividend. So we'll smooth the dividend over the whole year. So we plot for January. Then we repeat for February, and then we repeat for March, until we have all 12. So if you count them up, you'll have 12 points on your graph. I think looking at it from here, having designed it now, the points, the returns are very, very high. That we're going to get 16% from Ford Motor Company in 1 month would be pretty good. But you plot them and you'll get whatever you get. Once you've got your 12 different points on your graph, then you're not going to have to do this in the exam. But what we do, using a mixture of Excel and witchcraft, is we plot a line of best fit. So on your graph, therefore, you have a line of best fit. And that's what the red line is. So your red line, your line of best fit, goes through the points, or as close as you can get to the points, and it shows you, therefore, this idea of a straight line. Okay with that. So you've got your 12 points, your 12 points. You've got your straight line, which is your line of best fit. Not going to have to do this in the exam, but that's how it's done. In the good old days, you actually had to calculate all of these things with a pen and paper. Obviously, since the advent of computers, it's got so much easier. Download the information automatically. Once you've got your line of best fit, we calculate the angle of change. So have a look on there, and you'll see that there's this scraggy blue mark, and there's an arrow that points to it to I've called the beta. Now, if you've done your maths at school, you will remember from differentiation, is it calculus? Differentiation, dy by dx. So dy by dx is the rate in which the return on our individual share changes as the market portfolio changes. So that will give you a rate of change. And the steeper that line is, the higher will be the number. So just think about what it is just in terms of maths. It's actually measuring for you how the rate of change on your individual share changes as the market portfolio changes. Maths is called dy by dx. If you don't understand it, Google differentiation and it'll explain it for you. And that thing is what we call our beta. Okay? So that is called our beta. If we get 1, then it means that as the market portfolio changes by 5%, our share will change by 5%. So we get perfect correlation. You have a 45-degree angle. Yep. If it's more than 1, then it means it's more risky, because as the market changes by 5%, our share is going to change by 6 or 7%. So there's more risk. If there's more risk, we want a higher return. Similarly, if it's less than 1, less risky, so we need a lower return, and we would expect a lower return to compensate us for the risk, because there is this relationship between risk and return. Right, that's how the thing is calculated. You should know how that's calculated, not because you're going to have to do it, but because you will be asked to explain what the weaknesses of the model are. And the weaknesses are all in that picture. So we're going to come back to that in a minute. Right, I hope you get that, but that is what your beta is. Mathematically, is dy by dx, how the return on your Ford, remember Ford Motor Company we're talking about, Ford Motor Company share changes as the market portfolio changes. And when we say changes, we mean the return on them, yeah? Right, there's various games you have to play with that to get it to work, and we'll look at those in a second. Okay, so this slide is, so I'm laughing. The girls in my office here are just laughing at me because when we start this thing, if you have your mouth open, it preserves you as a permanent picture with your mouth open. Right, this slide hopefully therefore goes on and just explains all the stuff I've said. So it's a straight repeat of what we've just done. The slight difference is we've moved from Ford to Amazon. I should really read these things in advance, shouldn't I? So what do? Let's assume we're talking about shares in Amazon or Ford, which works the same way. We're going to plot the individual return on the shares against the return on the market portfolio. And it says here that there are 12 green dots. Now that I'm recording this down to go with this, they look like a sort of browny, beigey colour. But look on the slide and you'll see the dots. You can click your video back. So for January, we calculated the return, and then we did this for February to December, till we got 12 different points. We plotted the line of best fit, and then we calculate the slope of the line, and that gives you dy by dx. And that will give you the rate of change of the return in your Amazon or Ford shares compared to the rate of change of your market portfolio. And that is what we call beta. Okay, right, what beta tells us is this idea of risk. If it's 1, then your share, your Amazon, your Ford shares have a risk exactly the same as the market portfolio. Greater than 1, it's more risky. Less than 1, less risky. Right, then we're going to look at what you're actually going to do with this thing in a minute. I hope that's on the next slide anyway. Okay, so let's move on to our slide then. Right, our formula is, right, when it says our formula is, it means capital asset pricing model. Remember what it's going to give you. It's going to give you the required rate of return on a set of shares. So in our example here, we've ditched Ford now, and we've moved to Amazon. So we're going to look at what is the required rate of return of an investor who wants to purchase some Amazon shares. Now your formula is incredibly complicated, as with all these things. You're going to have this in that form. I took that from the actual ACCA formula sheet, but you should know it before you go into the exam, because CAPM is going to be there. Right, the whole thing on the left, therefore, is E open brackets RI close brackets. Right, that's the required rate of return of an investor who is purchasing shares in Amazon. And what does it equal? It equals RF. RF is the risk-free rate. Right, so the risk-free rate is what do you get on risk-free securities. We make an assumption, usually therefore, that these are government securities. So if you're in the States, there'll be T-bills. I believe that they're used for calculations in America, 5-year T-bills. In Britain, they will use gilts, and God forbid if you're in Russia, you'll use ICAEWs. So it's the risk-free rate, which is RF, plus BI, which is the individual beta, calculated using our graph, multiplied by ERM, right? ERM is the rate of return on the market portfolio, minus RF. So it's the difference between the market portfolio and the risk-free rate, multiplied by the company's beta, plus the risk-free rate. Now I really simplified my graph, and in fact that was how they did it way back in the 60s. The technology's moved on now. In fact, if you look in a big textbook that dedicates hundreds of pages to this, you'll actually see that they plot RJ, which is your individual share, minus the risk-free rate, against the market portfolio minus the risk-free rate. So that's kind of more accurate, but whatever, it works. Right, that's your formula. So therefore it says assume that Amazon currently has a rate of return on equity of 12%, the market portfolio is yielding 8, Amazon's equity beta is 0.8, and treasury bonds are yielding 6. Using that information, we would say therefore that the required rate of return of Amazon will be 6, which is the risk-free rate, plus 0.8, which is Amazon's equity beta, multiplied by 8 minus 6, which is the market portfolio yield minus the treasury bond yield. So it's this market risk premium is 2. So putting the numbers in the formula, it gives us 7.6. Right, just take a second and make sure you're okay where all those numbers come from. I'll take a second as well. Right, 7.6. 7.6 then, according to CAPM, is the required rate of return. So if you're doing something nice and simple, which says what is the required rate of return on Amazon shares, and you weren't given the 12% in the question, you would say required rate of return is 7.6, and bang de buck, there's your answer. What's going to happen to you in the exam is you're going to be asked to calculate Amazon's discount rate for net present value calculations. And Amazon's discount rate for net present value calculations will be 7.6. In fact, in the exam, don't take 7.6, take 8. Round it up. If you round it down, you can get wrong decision. Round it up, take 8% from your tables, and away you go. Okay, but I wanted to put a complication in this. I have no idea why, but it seemed like a good idea at the time. And the complication is that the current rate of return is 12%. Yep. So the current rate of return is 12%. Now we know that the correct rate of return should be 7.6%. So it tells you two things. Either something is going to happen which is requiring investors to get that extra 12%. So there is some sort of risk or something that's coming in the future, or that there's going to be a price correction. Now, one of the assumptions of capital asset pricing model is perfect market, so perfect information. So therefore, if you're getting this, it's telling you that there's going to be a very rapid correction, and the correction will be happening in the next few minutes. Perfect markets, everybody knows everything. Okay? So in fact, according to CAPM, this shouldn't happen at all. But trust me, it does. So, there you go. You need to be able to put the numbers into that formula incredibly quickly and get the 7.6%. Because that, in the exam, is almost certainly going to be your required discount rate in a cash flow, and you'll have to do the cash flow as well. Okay? I think you also need to be smart enough to be able to compare that with what the current yield is and say why the differences occur. Remember, perfect market. Okay? Right, there we go. CAPM. Okay, the problem with capital asset pricing model, and you need to know this as well. There are various, I've put assumptions and weaknesses. The capital asset pricing model is a model. So on the grounds that it's a model that kind of sits within some sort of vacuum, I guess it works within the realms of that vacuum. The problem with it is that the assumptions mean that in real life it doesn't really work. So what are those assumptions? Right, the first thing is that it's a single index model. Right, that means that capital asset pricing model assumes that the only thing which affects price is this one factor, which is the relationship between market risk and the price of the share. It ignores all other factors, so all other economic factors and so on. It simply assumes that they don't exist. Right, there are lots and lots and lots of things that go into making up a share price, human sentiment and ignorance being one of them. So it doesn't work. There are many factors, and in fact, when you come on, you'll come to a thing called arbitrage pricing model. An arbitrage pricing model seeks to specifically address this, and it brings numerous factors into what's affecting us. So therefore, arbitrage pricing model is a later model where you simply have a series of constants multiplied by factors. But the point is that arbitrage pricing model addresses this issue of the fact that it's not a single index. So that's the first one, single index. The second one is single period. Right, single period means that capital asset pricing model is only valid for one period of time. Remember what you did, you calculated what was dy by dx for a 12-month period. and that 12-month period was historic. The capital asset pricing model is valid for that 12-month period. Once you go forward in time, because why would you go forward in time? Remember what you're doing, you're going to be using capital asset pricing model to predict a net present value discount rate for a 5-year project going forward. As soon as you start to go forward, we move into the next time period. So January drops off, it disappears from our graph, and we get a new January. So January 2014 disappears, and January 2015 replaces it. When it does that, your line will move slightly. So therefore, when your line moves, you get a different dy by dx, and therefore a different beta. So beta changes as time changes. Right. What they do in real life now is I believe that they calculate betas over a 5-year time period. So we get this idea of a 60 months rather than just 12 months. And by doing that, the effect of taking out the first one and bringing in the last one becomes much, much less. We're still going to get periods though when, because of economic changes and the value of shares go down, so you get negative returns and so on. But then the question is that what is your beta actually statistically valid? It's a little bit like saying I can draw a line halfway between Moscow and Barcelona. Yeah, you can do it, but does it mean anything? Who cares what's there, kind of thing. So with your single period, capital asset pricing model is only valid for that single period of time, which is those 12 spots on the graph. No tax. Capital asset pricing model comes from portfolio theory. The whole basis of this is portfolio theory. If you have watched my video, which please watch the video, you will know that portfolio theory works on this basis that we have portfolios of shares, so portfolios of equity shares, and we can bring into it risk-free securities. And by bringing in risk-free securities, we can maximize our return in relation to our risk even further. So that's a basic predicate, a basic assumption of portfolio theory. To be able to do that, you have to be able to move completely freely from equities to bonds and back again. But you cannot move completely freely. There is capital gains tax, there are transaction costs, and also interest from bonds suffers tax. And interest from bonds suffering tax means that you are more likely to purchase equities. So that's the first thing to say about tax. Therefore, we can't move freely because of tax. The second thing is that the tax on dividends is different from the tax on capital gains. So this is the same point, but a slightly different slant on it. The first one was that we can't move freely between bonds and equities. The second thing about tax is there is a difference between the amount of dividends we get, because you pay income tax and dividends, and capital gains. Capital gains, if you just don't sell the share, are free. There is no tax. So therefore, to introduce tax into our model, our graph would actually become three-dimensional. So you have the return on the share which goes up, you have the market portfolio along the bottom, and then you'd have to have tax that goes backwards. So what happens is that your graph becomes three-dimensional. You can't calculate the model at a three-dimensional level. It just simply doesn't work. So therefore, on that basis, we have to ignore tax. Now, in real life, tax is hugely important. We get people who are exempt from tax. So me, for example, if I earn dividends on shares from companies in certain countries, because I'm non-resident, I don't pay tax, and the same for you. So tax is very much part of the equation, but capital asset pricing model simply ignores it. You just can't do that for a company. Remember, we're looking at getting a discount rate for net present value calculation. You will have to pay tax if you're a company. Number 4, perfect information. Perfect information doesn't exist. You can go look at your market portfolio theories, which are perfect information, the random walk, all of that stuff. The perfect information doesn't exist at all. So I say doesn't exist at all. That's a bit harsh. I think most people, the general assumption nowadays is that we do have good information, but it's not perfect. And we can still influence the market by having inside information. So perfect information. And we saw that before we find that things are different from what they should be. No information. No information is very, very important, because what's happening here is, imagine that you are dealing with an unquoted company. So you have a company which is not quoted on the stock exchange, and there are some fairly large companies that are not quoted on the stock exchange. Some small ones like my company as well. Right, well, I have no idea what the share value is. I guess the share value without me of my company is nothing. But so if you don't have any information at all about the company, it's not quoted on the stock exchange. So you can't use CAPM at all. So how are you going to do a net present value calculation? Well, in real life, we come up with something. But so no information is as valid an argument against CAPM as perfect information. No information on the company. Right, the final one, and my particular favourite, it doesn't actually work. We knew back in 1970, comparing CAPM, what it said we should get compared to what the market actually gave us, that there were differences between the two. What we actually find is that the band of required rates of returns is much narrower than CAPM would predict. So if you have a company which has a beta of 1, what you will actually find in real life is that the required rate of return and the actual rate of return are generally quite close. When you get a company which is very, very risky, so CAPM has a beta of, God forbid, 3 or something, so we would expect 3 times the market portfolio rate, what we find that in fact the rate of return on that really, really risky company is much lower. So CAPM will overstate the required rate of return. Spinning it around to very, very safe companies, so in principle food companies, things like water and so on, effective state monopolies, what we find is that capital asset pricing model will significantly understate the required rate of return. So the further away you go from a beta of 1, the bigger you get this diversification. And the conclusion is that it doesn't work. Now, people in universities are actually very, very clever. Because if you read anything on this, you will find that they will tell you that it's the market that doesn't work. Capital asset pricing model works perfectly. The market doesn't work, which is, I like that, I have to say. As a consultant, everything I do is right, and if real life shows that it's different, then real life is wrong. So you have a different interpretation on reality, I suppose. And that thing there, which looks on the slide like an A, but I've actually gone to great time and trouble to download from PowerPoint add-ins, is an alpha. So in the exam and in your textbooks, you will see things called alpha values. And alpha values are quite simply the difference between what CAPM says the required rate of return should be and what it actually is. So in our Amazon slide, we got 7.6, I think, and the actual rate of return is 12. So your alpha value is 4.4% there. So that's what your alpha value is. Okay, it doesn't work. Got to laugh, haven't you? Okay, that was capital asset pricing model. As we said, it's a theory. You're going to come on. I've got some stuff done actually from Modigliani and Miller, so when I get time, I'll repeat these soundtracks. It's going to be in your exam. You have to be able to use that formula, put the numbers in the formula. You need to know at least what some of the weaknesses are as well. In terms of getting 50% in the exam, just being able to say what they are without long explanations is enough. I do warn you, almost all the examiners at ACCA are academics. They're from universities. They're not people who work in real life, so don't go over the top on your criticism of this thing. Okay, that's capital asset pricing model. We've put up now portfolio theory. We've put up this one, obviously, which is capital asset pricing model. So you're going to get, I think there's another, oh God knows how many more now. We've got Modigliani and Miller to go up, which I think I've got to do the sound for. Then we've got adjusted present value, and then we've got what your examiner likes to call the traditional net present value, but which uses all of this capital asset pricing model stuff. When we do in real life, we would usually just calculate approximately what we think our cost of capital is. It's an enormous problem. Because the other thing as well is that you've got to remember that with calculating discount rates, what are you going to do if you're ACCA? ACCA doesn't have any equity. I don't know if ACCA is allowed to borrow money or not. Certainly at one stage, years ago, was almost bankrupt. So what do? Well, the easiest way around these things in real life is just say, okay, I have no idea what my cost of capital is, but I know it's less than 15%. Do your net present value calculation at 15%, And if it's positive, then you know you're onto a winner, don't you? If it's negative, then you calculate the IRR and say, let's make a decision. But it's very, very hard to do in real life. Okay, if you have any questions, you know where we are. Come and find us, and we look forward to it. I think we got a couple of 100 questions on the last one. So portfolio theory was hugely popular. So thanks a lot for watching, guys. Best luck with your exams. Bye-bye.